Welcome back, everybody, to the Informed Homebuyer Podcast. I'm your host, as always, Rich Curtis, and I've got my co-host with me this morning, Dave Miller. How you doing, Dave?
I'm well, Rich. Thanks for having me.
All right, guys. The Fed made their April announcement yesterday. There wasn't much said. You had to read between the lines, but there was a lot alluded to and a lot pointed to. So we're going to unpack all of that for you today. We're going to start off with what they said and what it means and how the mortgage interest rate market responded. And what that kind of means for housing moving forward. We're going to go through and show you a couple of clips of what he said and how we are interpreting that so you can kind of read between the lines for yourself. We'll give you a little bit of information on how all these things work and how they're going to wash downstream into the housing market so you can kind of make sense out of all the noise that comes out. The legacy media likes to really do a lot of panic peddling around all of this and, oh, the Fed's doing this and it's the end of the world. And I think it'll be really interesting for you. We're not going to bore you. We won't play more than 30 seconds. But to see the very calm tone, tenor, and approach that these people take to safeguarding our economy, there is no panic here in this guy. You'll see he's almost asleep when he's talking to us. So you can kind of take those big media, legacy media headlines, and then look at this guy, and you can see the discrepancy between what they're saying and this guy that looks like he took 4 Valiums before he hopped on stage to chat with us, or maybe he did.
Hopefully our audience isn't thinking that he can't be more asleep than you guys are, right? Like, yeah,
That's right. Depends on the day. It's
yeah.
allergy season in El Dorado County, so I'm on a lot of sleepy meds too. So we'll see if I slip up today. All right, Dave. So what did they tell us? What was the actual announcement? What are they doing with the short-term Fed funds rate? In case people don't watch every one of our podcasts, what else are you doing with your life? You should be watching every one.
Right.
Let them know the difference between that Fed's fund rate and our mortgage interest rates, and then how mortgage interest rates responded or didn't respond to what he said.
Yep. All right. So a couple things here is the Fed funds rate do not have a direct impact on mortgage rates. So I think they have an effect on it, but it's not a one-to-one. When you hear the Feds come out and they lower the Fed funds rate a quarter point or whatever their change is for that announcement, we don't see always a direct correlation between mortgage rates. Mortgage rates are dictated by the 30-year mortgage-backed security, and so there was anticipation that there might possibly be a rate reduction. I think that the consensus there was that we were going to hold steady just based on the underlying figures, the trailing figures, which the Fed has a dual mandate to manage unemployment and to manage inflation. Tariffs are or the potential of tariffs that are on and off again are putting a lot of strain on the Federal Reserve because they just don't know what's coming. So they decided to hold steady, but I think the consensus was that they were going to hold steady, but there was also the thought that, hey, is this guy going to get bullied into lowering rates because that's what, some folks are saying that he should do. And his job, his charter is to manage that dual mandate and to not take political influence. So I watched the mortgage-backed security, the 30-year mortgage-backed security all day, every day. We're within a window. Numbers don't really matter, but we're bouncing between 101 and 101.5 basis points. The 101.5 being a ceiling, the 101 being a floor of support. So usually when you break through those and you're go below 101 for extended period of time, that means the mortgage bond is coming down. That means interest rates are getting worse. We break through ceiling of support and we continue to go higher and there's more demand, then mortgage interest rates improve. So we're seeing a very steady, flat mortgage rates have not changed, really in 3 weeks. We're just hovering, in that on average in credit score. There's a lot of criteria that determines your interest rate, but between the 6.75 and 7% range is where we're hovering currently.
Gotcha. And it's safe to say that if they continue, if we hit the June meeting, we'll talk about why we think this is likely. If we hit the June meeting and they stay again, or whenever their next meeting, date is, if they stay again, we probably will see the mortgage-backed securities market stay flat. So our mortgage interest rates pretty much stay flat again. Is that fair to say?
Yeah, I would say that is fair to say, and that's the expectation. And I think that kind of the moral of this story is if you're a potential home buyer or you're looking to refinance, um, don't hold your breath thinking that rates are going to come way down. We might see quarter point bumps up and down, which on average, per eighth, based on your mortgage balance, is usually anywhere between 30 and $40 a month per eighth. So you're talking $60 a month or $70 a month, plus or minus, not enough, hopefully, to sway your decision making. But we are not going to see wild swings. I think the other anticipation is that we are still, or it was projected that we would see for the remainder of the year up to a full point of Fed fund rates reduction. So that would either be, 4 quarter point reductions, which my anticipation would be we're not going to see at the next meeting anything more than a quarter point.
No, definitely not.
And so that leaves limited time, and we would have to do a quarter reduction throughout the rest of the year at each meeting to get our full point reduction. But that doesn't mean we're going to have a full 1 point lower in interest rate. We might see a little bit of favorability. So instead of 6.75, we might be in the 6.5 range.
Yeah. And the reason for that, folks, is because what the Fed rate, when they talk about the rate, the Fed rate that they're cutting is the short-term rate. So rate at which banks borrow money. And so that's not directly related to the mortgage interest rates. Mortgage interest rates are tied to the bond market, most directly to the 10-year Treasury note. So there is one other event coming up that could affect mortgage interest rates, although I don't think it will, and we'll get Dave's opinion on this. We have the 90-day pause on the tariffs. We're whatever, 70, we got maybe 65, 70 days left until the tariffs unpause, unless he changes his mind in a 2 a.m. tweet storm between now and then. But for now, the tariffs will come off in whatever it is, 65 days. The market, the stock market, has been reacting to the tariffs coming on and off. So if the tariffs go, I think I said off, and when they're going to go back on in 65 days. So when the tariffs have gone on, the stock market is freaked out. The first time people did what they traditionally do, which is fly to safety in bonds. So they sell securities. They're selling their Apple and Google stocks, and they're buying government bonds and treasury bonds in the bond market as a more secure place to park their money. That happened way back in the beginning of the year at the first tariff announcement. On the Liberation Day, April 2nd tariff announcement, people were so freaked out by the scope and scale of those tariffs, they skipped right over bonds, flew to cash. So they sold their Apple, Google, whatever, and just parked their money in cash to either protect it, or, assuming the market's going to plummet like it did, 1,200 points or whatever, they can move the money back in and take advantage of better buying opportunities. When people fly to cash, we see no movement, no positive movement in the mortgage interest rates. When people fly to bonds, we see the interest rates get better. So the question becomes, when the tariffs go back on again in 90 days and the stock market freaks out and plunges, what do people do this time? Do they fly to bonds or do they fly to cash? Given the level of uncertainty being higher now, my prediction is they fly to cash again, and thus we see the mortgage interest rate stay flat again. Would you agree,
Yeah.
Dave?
Yeah, I agree. The other component to that, Rich, is, the amount that savers, folks with cash, they get the return on their money that are in banks is directly tied to that Fed funds rate. So for those that have cash or a strong cash position, you're getting, a little bit more on a CD, but, there's savings rates in the 4% range. Some as high, if, you might find it in the high fours and up to 5%. So that flight to cash is not like other times when the bond market was seeing 2, 3, 4%, but the most you can get on your cash was 1%. So there is some security in cash. It's not as much upside as equities, and you take risk off the equation. But shoot, if you're guaranteed 4% on your money and you can't lose, that's a pretty safe bet there.
Yeah, right. I think when we say fly to cash, people envision people like stuffing money in their mattress and their coffee cans and gathering up their guns and sitting on the mattress and waiting for the, defecation to hit the oscillation. That's not what we're talking. It's actually a reasonably financially prudent and fact-based decision to move money to cash right now because of the yield on cash savings that you can get versus the volatility in the market at the moment.
Yep. And then also for, large institutions, they do that for, folks with 401ks and other plans. Like, based on your age, you might say, hey, I'm tapping out. I'm just going to, I got 3 years left to retirement. I can't take this uncertainty. I'm just going to park it in cash and do some CDs and ladder that and get out of the market. And, so there's all kinds of reasons why people go to cash.
Yeah. But the upshot of that is if they do, when the tariffs go back on again, or even if tomorrow he decides, well, now we're going to hit Canada with 145%, like he's doing to China, any new sort of volatile move that the president makes could cause a reaction in the stock market, which historically would actually benefit mortgage interest rates in the short term. Right now, that mechanism has been decoupled
Right.
because the yield on cash is so good and cash represents such a safe haven that people are skipping the bond market and going to cash. So we won't even get none of this none of this tariff business is beneficial really in any way. The only one bright spot we would have gotten of interest rates getting better, we're not even going to see that because people will continue to fly to cash is our prediction.
Yeah, I think the other piece that people are missing here or that's not readily available is we're talking tariffs. Tariffs are not we've explained what a tariff is, but a tariff is not the only trade agreement. It's not either there's a tariff or no tariff. With all these countries, and Rich, you mentioned it earlier, we've had agreements with Mexico and Canada and things that people are familiar with. There was NAFTA and then, different trade agreements with different countries. And so if someone was to say, hey, what's our trade agreement with the UK or with, a European country, most people aren't going to know. You're not going to have any idea. So the tariff is a blanket tax that we charge on ourselves that goes to our federal government, not onto another foreign country, but it slows down our imports so that the other country is now encouraged to come to the table and rework those trade deals that are in place with just about every country. So we're hearing news now that, the UK is in the throes of making a trade deal. We're all these different countries or several countries have come to the table and they're negotiating trade deals. So those tariffs may go away for those countries because now we have those trade deals. Does it mean that the cost of goods and services coming in are going to go back to where they were? Maybe not, because that trade deal goes both directions. So,
Yeah.
you know,
Well, and because trade deals are being made now, as the U.S. has essentially gone isolationist and pulled ourselves out of the global free trade economy, those people are now making deals with other countries. I mean, things that you wouldn't even think, like Lindor chocolate. Anybody like those little round chocolate balls that you get for Christmas, or little squares? Lindor chocolate, they're great. They normally import to the U.S. and distribute from there. For North America, once Trump did all this business, they just switched and they import to Canada now and distribute from there. So all the money from that is now gone, and now they've signed a deal with Canada. So those things don't just flip flop and come right back, right? Like people are looking to buy fuel from other countries now, looking to buy corn and soybeans. They're buying from other nations now, and those now they've got a trade agreement with another country, and if they're happy with that agreement, they may not come back to the table. So as these things, even as Washington rolls back these policies, the likelihood of anything going back to what it was is next to zero at this point. There's going to be downstream consequences no matter what we do. The genie's out of the bottle in that regard, I think. So it's a really important point. And again, these things are so much more complicated than the average home buyer usually needs to pay attention to. But right now, this is the type of stuff that's really affecting the housing market and going to continue to affect the housing market in both the near and long term, because as we just articulated, these things have real long-term consequences. Another stated purpose of this is to onshore jobs, which we've talked about this on the channel before. It takes 3 to 5 years to bring a new auto plant online. It takes 3 to 5 years to bring a new lumber mill online. During the Biden administration, they eased the legislation that, environmental regs to get a lumber mill online so we could start increase our domestic lumber production here. And not a single one of those factories is even online yet that started up because of that easing. So this doesn't happen quickly. But what does happen quickly, just read an article about a guy who imports products from China. He had a container ship with about 100 grand worth of goods coming in. Trump slapped that original 10% tariff on. It takes months sometimes for these things to get here. He said, okay, I'll eat the 10%. When it got to port, Trump had done the 145% tariffs. He was looking at $150,000 tax bill paid from him, an American company in Southern California, to the U.S. government in order to get those goods out of port. He had another container about to leave port with the same amount of goods. Between those two containers, he's talking $100,000 in taxes paid to the US government on $200,000 of raw goods or materials. The math doesn't math. He canceled the shipment, said he wouldn't take custody of the goods, wouldn't pay the tax, laid off all 150 employees, and shuttered his 20-year business. We're not onshoring jobs. We are killing America's small businesses right now with these tariffs, especially the China ones in particular. The 10, 15, 30% ones, those are going to close some doors downstream, but the 145% ones are closing doors right now. These are taxes that we pay. China's not paying that $150,000. This guy in LA was about to pay it, and he just didn't have it. You can't pay 300 grand on 200 grand of goods. The math doesn't math. So that's what we're facing. And we're going to jump now into some clips of Powell talking in a very measured and more controlled way about those things. And we're going to try to help you read between the lines. So the guy you're going to see on the screen, maybe some of you don't know because you don't have to follow this stuff like we do. Consider yourselves lucky. This is Jerome Powell, the Fed chairman. Right now. And he is the Fed chairman through next summer. So let's see what he had to say in this clip.
The outlook and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored.
All right. So what Powell's talking about there is basically what Dave and I were just talking about, which is that the long-term effects of the tariffs are going to be inflationary. They're going to likely raise unemployment, and that's all going to have an economic effect. What he's speaking to is that it hasn't quite happened yet. It's the Fed's always looking in the rears at data, and that's not in the data yet because it's just starting to happen. That story I just told you about the guy in LA, that was like 2 days ago. So that stuff's not going to start reflecting in the data for another few months, which puts them in a hard position where they are looking forward, but they don't have data to base a decision on. And you can think about this like if you've ever made pancakes. I'm going to go Forrest Gump on you guys here, right? Life's like a box of chocolates, right? If you've ever made pancakes, everybody's probably had this experience. You put in the mix and you dump in some water and you're trying to get that right consistency. And then you dump in too much water and your pancake mix is watery and you're like, damn, what do I do now? I got to dump in more mix, right? And then you go too far and you've got paste and you got to dump in more water and you're chasing your tail and trying to get that mix right. That's how the Federal Reserve works in terms of fixing our economy. They can either raise the interest rates, and if they go too far, they then have to lower the interest rates, right? Or they can buy bonds or they can sell bonds. And they're constantly trying to do these things to balance that dual mandate of keeping employment at the maximum rate and keeping inflation at the minimum rate. And it's a very hard thing to do. And of course, you all know when you make pancakes, the first one on the griddle is burnt to hell. Right? You just never get that first one right. You always figure that one's going in the garbage. And that's exactly how this works. They pull one of their levers, it goes out into the economy, and then they see, oops, that didn't quite work. And then they have to come back and adjust their levers again. And right now, what they're saying, and the next clip's going to allude to, is there's so much uncertainty going on. We don't even want to pull either of our levers because whichever one we pull, we're going to burn the pancakes.
Yep. I agree. The other kind of analogy to your pancakes is guys like you and I, we eyeball it. So we're constantly chasing our tail. If we just used a measuring cup, right? We might get it right the first time. So
yeah, exactly. They just don't have the benefit of that measuring cup. Wish they did. That's we either just gained a ton of subscribers or that was too like hokey and redneck and everybody just bounced off. We're going to look at the graph on this and we're going to see at 19 minutes, that's when everybody dropped off this podcast when Rich started talking about pancakes. All right. We're going to fast forward here and he's going to directly address the uncertainty for you in this clip.
We are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses, the market participants, the forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
All right. So that was in response to a question, basically someone saying, hey, when do you think you're going to know what you need to know to start pulling those levers and make adjustments? And he's basically saying, I don't know when we're going to know, and we don't know now. And there's a lot of uncertainty. And all of the greatest financial minds in the country that make these projections and predictions, we're talking to all of them, and they all are feeling so much uncertainty. They're not willing to point us in a direction either, which means the smartest move is to do nothing. So the Fed is a little bit stuck or in a pinch right now. Is that your read on this, Dave, and why you're saying you think the next meeting will be about the same?
Yeah, that is my read on that. And I think the other thing that they reiterated and will continue to reiterate is they can act quickly. And it's way easier to implement quickly a change than to undo a change that was premature.
Yeah.
It's
at the risk of losing more subscribers. That's the burnt pancake. We're gonna wait, and we're gonna watch that first pancake burn, and then we're gonna swoop in quickly, adjust things, and get it right.
Right. Or we'll wait and see that first one burnt, but that doesn't mean the second one's going to burn. So if two burn, then we're going to make a change. But if the second one doesn't burn, we're smart to hold our ground there, because we're looking at trailing data, and one blip doesn't make us make those changes or pull that lever. We want to see a pattern. We want to see that pattern before we make a change. And same thing to the pancake analogy. Maybe it's 3 pancakes that got to be burnt that says, oh, shoot, this isn't working. One, maybe 2, so it's that kind of ready, shoot, aim philosophy versus ready, aim, shoot. Like, we're just going to wait, and it's trailing data. So,
yeah. And I think even though the American people aren't looking at the CPI numbers and all these things, your average person on the couch right now watching this doesn't track all this data. They fundamentally are feeling the same uncertainty, and they're making the same decisions, which is to pump the brakes on making major financial decisions and wait and see. And that's what's affecting the real estate market. We're going to watch one more clip, and then we'll circle back to that. But the American people, you don't need a degree in economics to look around you and be like, it's chaos right now, I'm not going to splash my money around. These are smart people. They've been on the planet a long time, and they know when it's time to, hold back a little bit. And that's what's directly affecting our market. So I think we're starting to see in our data that the American people are starting to make the same decision that Powell's making, which is the only decision you can make right now is wait and see.
Right.
Let's jump into one more clip here where he is going to do a little bit of future casting. Now, this guy is very restrained, as you can see, very conservative, not politically conservative, but conservative in his speech, in his tone, in his tenor, and in his response to crisis. And so he doesn't do a lot of future casting. But in this next clip, he's going to say a little bit in a reserved way about what he thinks is coming up. I should say, too, there's a lot of the president is calling to fire this guy, because what the president wants right now is the optics of rates coming down. He wants the American people to see rates coming down as an offset to how terrible the economy is doing, because that will look good on him. So he's putting pressure on this guy. I didn't pull this clip for you, but someone asked him, the pressure from the White House, how does that affect your decision making? He said, it doesn't. We do our job for the American people. So this is all in a very nonpartisan space, and I think this guy does a very good job. But it's important to note, as the president criticizes this man, that he appointed him. Jerome Powell is a Trump appointee from Trump's first term, and then Joe Biden kept him on because he was doing such a good job. So regardless of where you sit in the political landscape right now, your party put their stamp of approval on this guy, whether you're Republican or Democrat. Maybe if you're independent or libertarian, you can wash your hands of responsibility there. But for the most part, the two dominant parties both have said, this guy's doing a great job. He's doing a good job in a nonpartisan way. We're going to keep him. So what's that, Dave?
Yeah. Well, I think the key there is, if you're just watching news clips and, the White House says we should be lowering rates. Yeah, we should be lowering rates. That's what your initial reaction would be. But if you're watching this podcast and you're digging deep into the reason why what the Federal Reserve is doing and what their mandates are, now it makes sense. Okay, probably shouldn't. So that's what we're here for, is to just explain what goes on behind the scenes and why we just don't, pull levers at a whim.
Yeah, and I think this man has the most powerful man in the world coming out on TV saying he's a chump and he should be fired, and all this stuff. And he's not buckling under that pressure. He says, my role is to keep the economy safe, safeguard the economy for the American people.
Yeah.
That's what I'm going to do, regardless of political affiliation. So to that degree, I think he's doing a great job and deserves a lot of grace and understanding. And I would encourage people to throw aside the character assaults on this guy and remember, this is him and the rest of the committee underneath him. These are the people that shepherded us from double digit inflation to where we're at now, hovering just above 2%. These are the people that delivered to us the strongest, most robust economy in the world post-COVID. And it's good to remember that the inflation we experienced was a COVID-based inflation that the entire world experienced. It was not there was no political party affiliation to this inflation. It was a global phenomenon, and these people did the best in the world at managing it. So, for my money, I'm going to bet on them to shepherd us through this next round of insanity as well. And I really hope he at least makes it through to his summer 2026 sunset date. And I hope we get someone as equally competent to shepherd us through this next one. So let's see what he has to say in terms of future casting here.
Well, let me say, so let's look back and see where we are. So go through 2024 up to the day. We've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, and if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. We might see a delay in that. And I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say year, we would not be making progress towards those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preempt.
All right. So what he ends up going on to say there, and what they're asking about, is could you preempt a recession by starting to pull those levers? In the Great Recession in 2008, the economy was clearly tanking. It was a sinking ship. And so all of the data, all of the blinking red lights were saying, hey, do this. So they did the everything. So we talk about how the Fed has, they can raise or lower rates, or they can buy or sell bonds. So there's some other things they can do as well. They can change the reserve level of banks. So banks have to keep a certain level of reserve. So say for every $100 they lend, they got to keep $10 in the bank. The Federal Reserve can lower that so that the banks can lend more money to stimulate the economy. They can also do something Dave and I have talked about in regards to the Great Recession, quantitative easing, where they go out and they buy the securities that aren't bonds. So right now, when they're dumping bonds off the balance sheet to keep the interest rates up, they're mostly playing in the bonds market. But during the quantitative easing, they started buying mortgage-backed securities, which is something we could see come back again. They did all of that in the Great Recession as quick as they could to try to right the ship. What he's saying right now is that we don't have all those blinking red lights. We got red light, green light, red light, green light, red light, green light, and we can't start pulling those levers yet. And people are pressuring him to say, well, it's obvious. It's obvious we're going into recession. You've heard Dave and I both say we believe we're going to be in recession. I guess it's technically incumbent upon us to say that recession by definition is 2 quarters of GDP contraction. We only have seen 1 quarter, so we won't be able to officially call a recession until we see next quarter's GDP numbers. And Powell talked about the fact that they might not be as bad as we think. The next round of GDP numbers, not something he wants to wait and see. He thinks that tariff insanity caused some, and the pre-buying of goods from overseas to buy and get them onshored before the tariffs caused some craziness in those GDP numbers, and we won't see another round of that because once the tariffs go on, people will stop buying extra from overseas. And so he thinks the GDP numbers were muddy. Maybe Dave and I are wrong, and we won't see recession numbers in June. But I'll bet my, I'll bet everything I got there that we're going to see recession. And so what he's saying is we don't have clear enough signs to start pulling the levers yet. Yes, I acknowledge that if the tariffs continue, then we are going to see unemployment rise and inflation rise. But I can't guarantee the tariffs are going to continue. And I can't guarantee there won't be some other insanity or fiscal policy that happens that changes the effect and how these things work, because this is a self-inflicted wound. This is not sort of global or national forces causing this. Is one guy, flinging fiscal policy off the Resolute desk quicker than we can say Sharpie that's causing all this. We can't really say with certainty what's going to happen. And I'm not pulling any levers until I have more certainty. So that's that the big story here is what we've been talking about for weeks on the podcast and on my regular videos on the channel, is that we were originally driven by a lack of inventory in the real estate market. Then we were driven by interest rates. And now the real estate market, the national economy, and to a large extent, the global economy is now being driven by fear, uncertainty, and doubt. And the thing I don't like about that is nobody makes a good choice when they're scared. So what's that, Dave?
Yeah, no, I was just you brought up the housing market, and I know we talked about that a week ago. Are we week over week? Is that enough time for you to see much change, or?
No, month over month is sort of a minimum time frame to make any predictions. But our month over month numbers were already showing cracks, chinks in the armor, basically, where we're seeing an increase in new listings coming to market and a decrease in closed sales. So we have been in lockstep, where we had such low inventory that if we got a few new listings, the buyers jumped off the fence and bought all the listings up, and our inventory would stay low and pretty static. And that's been all the way since COVID, and even through the interest rate hikes, that really didn't change appreciably. And now we're seeing the lock-in effect easing, more listings coming to market because either people are just ready to move and they know interest rates aren't going to 2 to 3% again, which we've been telling people on this pod for a year now, or because they're profit taking, because they see what we see, which is the likelihood of some losses in property value by the end of the year, and they've been waiting to make a choice. Now they're like, heck with the interest rates, I want to take all this appreciation I got. So listings coming up, but the buyers aren't coming up to meet them, which is causing an overall cooling trend in the market, which I expect to continue. And I expect to continue regardless of what Trump does at this point, because it's fear and uncertainty and doubt that's running the market now. So nothing he does from this point forward changes that. He could come out and win a tweet storm tomorrow and say, it's all just kidding, it's all off. Let's go. We're going back to business as usual. And everybody would be so stunned and gobsmacked by that move that they'd be freaked out. It's like when you train your dog, you train them with positive reinforcement. You don't smack them, because if you smack them, they never know when the next smack is coming, and then they become afraid of you, and that relationship is broken. The American people have already been smacked enough times this year that it doesn't matter what he does. That fear, uncertainty, and doubt are going to continue. And that is going to continue some downward price pressure on real estate prices continuing forward. It would take 6 months to a year of him, keeping his thumbs off the tweets and not, smacking the global hornet's nest before I think people start to feel comfortable to move their money around again.
Right. Well, side note, as I got a call yesterday for someone that had most recently had a 3% interest rate, and they wanted to refinance and take out some money. Understanding that rates were in the high sixes for them. And, even though they were doing a shorter term amortized loan, it was still, more favorable for them to do that and to pay off some consumer debt than to just kind of wait and let that consumer debt continue to pile up. So sometimes, the market is what it is. It's going to be like that for a while, and you got to make these decisions based on, where we're at now and where we expect to be.
Well, yeah, I think there's some fear too. And so people are starting to want to have some money in reserves and things like that. Like I think we're piling up on the bad dad metaphors in this podcast, Dave. But when you're winning the game, you've got a different layout with your team members than when you're losing the game. You switch from being really aggressive to being defensive, depending on what's going on. And I think everybody's switching to defense right now. And so okay, maybe I take out a 6% interest rate and I refi, but now I've got a pile of money there in case I lose my job, or to pay off consumer debt to lower my monthlies because everything I buy at the grocery store and at Target for my kids is all going up, and I need more cash on hand. I need, less tax on my monthly bills. So yeah, there are people who are making changes in their financial house right now, and that's going to have some follow-on effects in the economy as well. But yeah, in the meantime, there may be some people doing some refis to shore up their financial position, whether that's to pay off consumer debt, which is at I mean, you can speak to this. It's something you follow. Consumer debt's at like all-time highs at this point, right?
Yeah, 100%. Yes, the highest it's ever been, and trillions of dollars in credit card and consumer debt. That something's got to give, right? Like that can't
Yeah.
continue to go at that pace. So
And those all are at 20% interest and whatever on a credit card. Now you see
right.
your monthly bills go up by $400-$500 because everything's costing you more, gas and food and everything else. And now most Americans are living paycheck to paycheck. So now your budget is squeezed. How do you make more room in that budget? Well, you refi and you pull out money at 6% and pay off the 20%, and you bring your monthlies down by $250 to accommodate the cost of your food and whatnot. And those are unfortunately the types of compromises and the types of thinking that I don't think that the president's really taking into account as he continues this sort of trade war business that all of us everyday, feet on the ground, Main Street Americans are having to make those choices. So yeah, there could be a little movement in the mortgage market just by people, kind of rearranging their financial house to weather this storm. Hope that none of you are in that position. But I think the main takeaway here is that what we've been saying on the podcast for months now, we hear the Federal Reserve echoing that. The tariffs are going to be inflationary. They are not paid by China. They are paid by us, everyday Americans, first by the American companies, and then by us as the consumers, as those companies pass on the cost of goods and services. They're not going to onshore jobs. They're going to cause the closure of a lot of great American small businesses. And that trickles down to the housing market, not because there is substantive changes in the metrics in the housing market, but because buyers are afraid and they stop buying, and then the market slows. So that's really what's happening. People are nervous, and it's rational, easy for me to say, rational to be nervous right now, and that's causing the slowing the housing market. I expect that to continue. Dave, what's your stance on that?
Yeah, at least I think throughout this year, hopefully not as long. I do think we'll get some, ups and downs in news that we're hearing that trade deals are being made. And I think a good way to kind of watch that is you watch the stock market, the S&P, the Dow is, it's a little bit of a roller coaster. And every time, a trade deal was met or a framework is in place, then there's a short-lived euphoria. And so I think that's just the pattern we're going to be on for a while.
Yeah. If I could say anything, I would say turn off your TV, go for a hike with your kids. Don't ride this emotional roller coaster. And look, if you don't have to make any moves right now, then none of this really affects you. And if you are thinking about making moves, then just hit the subscribe button, like this podcast, follow along with us week by week. Dave and I will take years off of our life and ride this emotional financial roller coaster for you. And we will deliver to you the synthesized version, how it affects you every week over here. We are at 38 minutes. We appreciate you spending over half an hour of your life on your own financial education and listening to us. We're blessed that you're here every week with us. Thank you so much for watching. I'm Rich Curtis.
I'm Dave Miller. Thanks, Rich.
And we will see you guys next week on the next one.